An error occurred.
Technology is great when it works.
Yep. It's perfect when it works. Let me check something. How many hours do I have on my account? Is it I see Brandy. Thanks. Brandy, there wasn't a my link apparently never launched last night or saved. So
Ah, I'm sorry. Yeah,
yep.
I just looked at my phone and opened up StreamYard.com and it took
Sorry.
me right in. So I'm
I had
sorry.
my hand in fish fillets and I was like, ah crap. So I was texting you through Siri. So all right, I'm gonna take you
Hi,
off,
hi,
Brandy. You good?
Brandy.
Hi,
Oh yeah,
Hammer.
you can say hi to Hammer. All right, let's see if we can get this thing to go live. Going live. Here we go. Come on. Now we're there. Hey, good Wednesday, VA, and all of our channels that we're broadcasting on. Welcome back to a mortgage market update with Hammer, Jay, Helmer, and VA. So my name is Nathan Nottingham. Happy to have you all here. Hammer, thanks for showing up, man. Always.
Thanks for having me. Thanks for having me, Nathan.
Absolutely. So, apologies for starting a little late. I had the awesome opportunity. My parents are in town for a couple weeks. We got a guided trip on Lake Texoma. Went out and hit some striper bass, and this morning, and that was took my son and my dad out, and we limited out. It was awesome. Had a great time. So I'm running a little behind schedule today.
Well, it's awesome that, hey, family first. And the rates will still be here when you get back. That's always the case.
Yeah.
They'll always
Isn't that
be
the
here.
case?
So, well, welcome everybody. And if you're watching this live, do us a favor, go ahead and say hi on the comments because that lets us know that you're here. Otherwise, we feel like we're staring at each other's computer screen talking to each other. So let us know you're here live. And if you're watching on the replay, do us a favor, give us hashtag replay. It's really important us to know that you guys have this as a resource. And if you do watch it at a later time, just let us know. That's a great way to just share with us that you guys are watching this and that it is helping you. Feel free to ask any questions. We do monitor the chat afterwards, so we'll be more than happy to answer those for you. And I got a question for everybody. Do me a favor, Nathan. Show my screen today. I do a Facebook Live, everybody, for a lot of mortgage professionals, and I like to do a question of the day. And today's question of the day is, what color tie do you think Fed Chair Jerome Powell is going to wear at his first live press conference in 2 years? Nice. So today, now we said definitely not a green or a yellow because I don't think I've ever seen Powell wear a green or a yellow tie. He's not a Trump red power tie kind of guy.
Nope.
He generally runs a bit of a maroon or a purple. He's got some gray in there. So I'd love to know if you guys have a guess. It's 12 o'clock Eastern time. His press conference is at 2:30 p.m. Eastern time. Let's take some guesses. I'm thinking, in honor of their 50 basis point rate hike, which we're going to talk about today, I'm thinking Fed Chair Jerome Powell goes in with a bit of a maroon tie. I think he's feeling.
You know what? I'll tell you what. If you're
think?
watching live right now and put your bet in there, you've got until 2:30 p.m. Eastern. And if you get the question, if you're the first one commenting to get it right, I'm going to send you a Vetivier hat.
Awesome.
Yeah,
I love that.
Up the stakes a little bit because I'm going in. I know what I'm going in, but I'm not going to say it out loud. So
I was going to say we got some light grays. We got some.
Brandy just said
she's
purple.
Go purple. Yeah, he's definitely
you don't qualify.
You're you can't have that, Brandy. But yeah, he's got some definitely a purple vibe, but I think he's going with the maroon. He's not a bright red power tie guy, but I'm thinking he's feeling either a pink or a maroon today. Because today we have the Fed very likely to raise rates 50 basis points for the first time since 2000. So we're talking 20 something years now that they're looking to raise rates 2000s. And let's talk about this Fed rate increase and what does that actually mean for mortgage rates. Now we can turn the screen off for now and we'll just tell you our talking heads, but the first thing that everybody wants to recognize is that the good news is mortgage rates are not going to go up by a half a point today. You're not going to see your rate suddenly jump up a half a point when the Fed raises the Fed funds rate by a half a point today. And this has already been priced into the market, and it's not a one-to-one scenario anyway. What happens is the Fed has what's called a dual mandate. where their job is to try to keep inflation at or around 2%, and they're trying to maximize labor, right? And the labor force and employment. So right now, we all know, anybody that's gone out to the pumps, gone out to buy food, inflation is out of control. Everything is getting more and more expensive. In fact, the Fed's favorite gauge of inflation, and there's a couple different gauges that we use to monitor inflation and to assign a value to it, is 6.6% last month. And that's the personal consumption expenditure gauge. That's how much people are spending on different items. And that is well above the 2% mark that they're looking for. So the way that the Fed tries to slow the economy down and get inflation down is by slowing down consumer demand. And they're going to do that by making it more expensive to borrow money. And the way that they do that is by affecting the Fed funds rate. And it's kind of, I got to tell you, it's really just kind of confusing when you try to figure out, okay, so the Fed has the ability to raise one interest rate. It's the only thing they have control over. They raise this Fed funds rate, and that's the rate that banks lend each other or borrow money from each other and the Fed in overnight. And they need to borrow money or lend money overnight because they're required to have a certain amount of assets based on how much they're lending and how much they're going. And that keeps the stability and strength in our banking system, right? So the Fed can only affect this one rate. And this is the rate that banks pay each other to borrow money. So why does that have such a big effect on the economy? Well, there are a lot of other rates that are actually set off of this Fed funds rate as a starting point. And the biggest one that you may know of is the prime rate. And the prime rate is usually 3.25% above that Fed funds rate. The Fed funds rate today is 0.25%. So prime is about 3.5%. And that prime rate is attached to your credit cards. It's attached to your home equity lines of credit. It's attached to car loans and student loans and payday loans. And, basically all of these other loans are based off of this prime rate. And as the Fed is expected to raise interest rates this year, right now, that Fed funds rate, 0.25%, they're expected to bring that up between 2.5% and 3% this year. And that's a big move up. And what that does is it makes it a lot more expensive to borrow money. So putting money in your credit cards, the car loans, it's, people that may have been buying a new car because they could get a car loan at 2.1 or 2.9%. Now they're looking at 4 or 5%. Maybe they don't buy that new car. So that's how the Fed tries to stabilize and control the economy. So when the Fed raises rates, most likely we've already expect a 0.5% or a 50 basis point increase. And when we talk in basis points, that's just mortgage nerd talk. Basis points, 100 basis points is 1%. So 50 basis points is 0.5%. So we're expected to see a 0.5% rate hike today. But that's not what's going to get all of the markets and investors roiled up. What's going to get everybody roiled up is what they think is going to happen moving forward through the next few months and into the end of the year. And it's expected right now. And if you don't mind, flip that screen on for a minute. I'll show everybody. This is a kind of unique insight into where we're at. This is called the CME Fed Watch tool. And the CME Group is a company that monitors what are called Fed futures. And it's kind of like betting on the ponies. There's always some kind of betting going on Wall Street. And right now, the probability of a Fed rate hike today, May 4th, at this Fed meeting, or as they call it, the Fed Open Market Committee meeting, the FOMC meeting, there is a 99.8% expectation that we're going to see those rates go up 0.5%. And when that happens, we're not really expecting any movement from that. Everybody's like, okay, we kind of figured that. And in fact, that's why mortgage rates already went up. And I'll explain that in a minute. The June meeting, though, there is a lot of expectation in the Fed futures. It's now, this was, the last few days, it's gone up just quite a bit. There's almost 100%, 99.8% belief that we're going to see a 0.75 point rate hike at the next meeting about 6 weeks from now in June. And that's what everybody is looking for insight into. They want to know, is the Fed leaving the door open? And what happens, this is a cat and mouse game. It's a chess game. And investors in the markets, and that includes where your mortgage rates come from because it's based on market activity, the markets are trying to anticipate what do they think is going to happen in June, in July, in August. So they're going to be looking for just the smallest change of verbiage to what the Fed says. And the Fed, they don't want to shake up the markets. So they try to telegraph what's going to happen. Sometimes Fed speakers who speak outside of a Fed event, they may just flat out say, hey, we think that we need to be very aggressive to fight inflation. And we think that we need to hike interest rates by 0.5%. Sometimes they'll be that bold and they'll say it that clearly. Other times they'll just kind of vaguely not. It's what they don't say. They won't say, well, it's off the table. They'll say, well, we're going to have to assess based on each meeting. And then what's going to happen is the investors are all going to look at that and go, whoa, whoa, whoa. Okay, that's a big deal. They're leaving the door open. We know that this could happen. Now, we've been talking about mortgage rates going up for months. And in fact, this is a Freddie Mac survey. And I'm not a big fan of the Freddie Mac survey, but it does give us a starting point. One thing I want all of you all to know is that when you look at the Freddie Mac survey, it's not an actual interest rate that you would expect to hear from everybody, just an even interest rate, or what we call par, right? It usually includes points. It's going to depend on credit score. So there's a lot that goes in this, but this is a good indicator for following over time, but it's not what you want to compare the mortgage rate quote you received yesterday on versus today. And in fact, Christopher's not here, but if he were, he would tell you, if you're going to get a mortgage rate quote today, what should they do to get that quote, Nathan?
Lock it in.
Or shop around.
Or shop around. Yeah, shop around, but make
That's
sure
where
you're
I was
shopping
going.
apples to apples. You're right.
Yeah.
Shop around, but also compare, like get a locked note, like know where you're at.
Yeah, and the good news, again, I forecast everybody. I'm trying to anticipate the future. I don't have a crystal ball, but I am pretty good with the tea leaves. And I think that we've seen a really, really high interest rate jump at the beginning of this year. So if you look at this chart here, and you could see from April of 2020 to April of 2021, rates were down a little bit, but not too much movement. This was almost flat. And then you could see from 2021 to 2022, same thing. They were not really too big of a move. It would go up, it would go down, but overall they stayed within a very close proximity. And it was only right about here at the beginning of this year that we look like we're climbing Mount Everest, and everything went straight up. And we have seen rates jump in a move that we have not seen in literally decades. We've not seen interest rates rise this quickly. And the reason that rates rose this quickly at the beginning of the year was the markets and investors anticipating what the Fed was going to do to try to keep inflation in check and slow down the economy. So all of this movement that we see already is based on the speculation of what the Fed is going to do. So when we see that Fed make their moves today, most likely we're not going to see rates move up very quickly right afterwards. In fact, the last couple of Fed meetings, if I go back and I look at what we call mortgage-backed securities, and these are the basis of your mortgage rates. This is the bonds that are traded that actually set that baseline for where your mortgage rates come from. And when we look at the meeting in January 26th, right about here, they were actually flat. So what we're looking for is these. In fact, let me go ahead and move this we're going to move this to a line chart, and that way it's a little clear. So right here,
go.
Thank you. So January 26th, right? We were right about here. And if these lines go up, that's actually good for mortgage rates. This is an inverse chart. So if the lines go up, that's good for pricing. That's good for mortgage rates. That's better for you. If the lines go down, that's bad. And that's why we've seen from the beginning of the year, this line goes way down. So looking at that January 26th area here, you could see that we didn't really see much movement at all. We didn't see a big drop down, not until later, a few days later. And that was because of other events. The last meeting we had was in March, and that was March 15th. And that meeting was right here. And it's that same thing, 15th and 16th. The 16th was when they actually came out with the Fed policy statement, when the Fed came out and said what they were doing. And Fed Chair Jerome Powell came out with his press conference. And that day, just like today, we saw a lot of movement. So today could be a scary day. Your lender may say, hey, rates got a little bit worse, today. They may got a little bit worse this morning. They make it worse this afternoon. But what we saw last time in March, we actually saw things get just a little bit better right afterwards. And I anticipate we're going to see a similar reaction today. And I can't tell you the future, but I can tell you why I think this is going to happen. I believe that we've already seen markets price in the expectation, as I showed you on this chart, of where the Fed is going to act. The market is very, very secure in their belief of exactly how the Fed is going to handle these things. And
Yep.
in June and in July, we're expecting to see these very significant increases to the Fed funds rate, which will cause money to be more expensive throughout this system. The good and bad news, the good news is it's already been priced into your mortgage rates. And the bad news is it's already been priced into your mortgage rates. But I do think we're finding a little bit of a leveling off. And what I'm hoping to see, and I'm expecting to see, and I'm putting myself out there, and I could be wrong, but we're going to be able to look back in a few months and see if I was correct or not. I think we're starting to see a settling in here. And we're going to see movement more along the lines of what you see right about here. This kind of movement right here, if you guys see that on the chart, where it's just up and down and up and down. But really, I mean, where you started and where you ended, very close. Versus if we were to look at that same time frame here, we started all the way down here at 4% and then bumped up to 5%. So I think we're going to see rates that are going to settle in the fives. Those of you that are buying new construction, you can turn this off now, put our heads back up if you don't mind.
Yep, sure.
Those of you that are, buying new construction and you might have a few months, I think you've got a lot less to worry about than you did a couple of months ago. A couple of months ago, it was very obvious that we were going to see rates go up, and, locking in was a very important decision because you were going to see rates that might be 1 or 2% higher in a few months than where you're at now. It could happen again. This absolutely could happen. Anything can happen, but I don't think that that's going to happen now, though. I think things are settling in. I think we're finding an average for many of you to find rates in the fives. We're not going to see rates go too much lower, but there'll be some windows of opportunity where you may get a little bit better rate than some days than others, but we're not going to see rates go on a drop. So don't hold your breath looking for that. If that's going to happen, it's not going to be until very late in the year or maybe 2023, after all of these moves that the Fed is making now have their time to have an effect on the economy, slow things down. If we do,
100%.
in fact, see the recession some people have speculated is coming, that'll bring rates down a little bit. But just, what's gone is gone, and where we're at now is what you want to be into. And I think you guys are in a great spot, though, where things are settling in. Home prices should hopefully settle down a little bit. We're not going to lose a lot of value. We've talked about that week in and week out. So I think it's still a great time to be buying a home, or if you're, if you're in a position where you need to refinance based on some other concerns besides interest rate, I think it's okay. So that's my take today. Go ahead.
That's a great take, and I appreciate it. I'm going to say this: a couple things in the industry, in the mortgage industry, you'll hear maybe you'll hear a term. We'll say, if you like it, lock it, or if you love it, lock it. I'm going to tell you this way. I'm going to change those words. Alliteration's awesome, but if you are approved with it, lock it, because that's kind of where we're at right now. And remember too that a mortgage interest rate getting you into a home is not the rate you have now for 30 years. You're going to do things, and we talk about this almost weekly. And if you are a VA or veteran spouse, if you are VA eligible and you're buying a house, or you're using your VA benefit right now, remember you have the VA IRRRL on your side. That interest rate reduction refinance loan allows you to do a very streamlined, very cost efficient refinance in the future. After 6 payments in 210 days, you're eligible. So if we do see rates change in the next couple of years, right, we're coming out of this recession pool and we start seeing this modification, and the rates come back down, you have the right product to then hop in there and quickly, efficiently, and inexpensively refinance that loan to get the lower rate in the future, and sometimes not even recast it to another 30-year note. You can actually pull that back to the current pay structure you have, like years left on the note. So so we say that often because if you can afford it and you're approved for it, lock it and get it done and get it set. We're not seeing any signs in the future of a big rate drop, so don't hold your breath. And remember, nobody gets a prize for having the lowest interest rate out there.
Nope.
Maybe bragging rights are with your buddies, but at this point, getting that getting financing is key.
Yeah, but it's a great prize to have equity, continue to increase. The fact that you have your money making money, you're able to leverage and have, your home go up. And the reality is we really do anticipate that home values will continue to go up, not as quickly as we've seen the last couple of years, but the average is 4% a year. And if you've got a $400,000 home at 4%, that's a good amount of money. That's, Absolutely. I don't know. My redneck math is about 16 grand in equity at, so hey, I could be way off though, y'all. But think about it. And it's equity.
It is equity, right? It's both the equity, the gain, the value of the property, and it's equity when you pay your principal down, right? You're earning on both sides of that equation. So keep that in mind. Hammer, that was perfect. I appreciate it. I will also say too, we're seeing a rise in home equity lines of credit. There's a lot more interest in the HELOCs out there right now, and that is because a HELOC, a home equity line of credit, takes a second position on the equity in your house without touching your interest rate on the first. So if you're interested in that, make sure you talk to your mortgage professional. If you're looking at, I've got all this equity, but I don't want to like get rid of this 3% interest rate I have. What in the world do I do with that? You might be in for a home equity line of credit. Those are based more on the bank rate than they are on the mortgage-backed security rate. But there's great opportunity there to just educate yourself on what it is and what it looks like. I think actually Christopher posted about HELOCs yesterday in Vetivier. So if you're curious, search that up. All right, everybody. That was a straight to the point call. Thank you, Hammer. Appreciate your faithfulness weekly to be here. Vetivier, if you're watching on YouTube or in our Facebook, let us know. Send a comment. We do monitor these after these calls, and we watch to see how the rewatch is going, and we're here to answer questions after the fact. So put your questions down below in the comments, and we'll be there to help you out. Appreciate it, everybody. Thanks, Hammer. Have a great week.
Thanks, Nathan. Take care, everybody. Bye-bye.
All right. Bye-bye.